Hello everybody, welcome to another episode of Erickson TV. Curtis here with Lauren. Hey Lauren.
Hey everybody.
Lauren, I thought for our second series of going back to summer school,
right,
we would talk about some of the current topic in the news, which is about sort of some pessimism about our future, the economic pessimism, you know, the unemployment. And so I found an article in Time Magazine I thought was interesting. I wanted to get your comment about it.
Okay.
If America's economic landscape seems suddenly alien and hostile to many citizens, there is a reason. They have never seen anything like it. Nothing in memory has prepared consumers for such a turbulent sort of upheaval that only happens once every 50 years. That may explain why so many voter polls taken as the economy shudders toward the next election reveal such a ragged emotional edge, so much fear and misgiving. The outward sign of the change in the economy is that the economy stubbornly refuses to recover from the recession. In a normal rebound, Americans would be witnessing a flurry of new hiring, new investment, and lending in buoyant growth. But the U.S. economy remains almost comatose, a full year and a half after the recession officially ended. Now, unemployment is still high. Real wages are declining, and at a time Economic Forum last week, forecasters predicted that U.S. growth would amount to only 1.8% this year and 2.6% for the next year, about half of the speed of the normal recovery. The current slump already ranks as the longest period of sustained weakness since the Great Depression. Right. Sound familiar?
Yeah.
Interesting though, this article was written in September 28th, 1992. Does that sound really similar to what you're reading that?
Oh yeah.
Okay.
Absolutely.
And so, do you mind writing 1992 up here?
Okay, 1992.
And let's go ahead and write today right here, which
today?
well, yeah, it's June 30th, but today. Okay. And the reason I wanted to bring this up is that there's been a lot of going on since that article first came out in '92. We did have a nice economic run. We had another cyclical stock market crash, and then a second one more recently. Interestingly enough, is this was the U.S. Stock market measured by the S&P 500 on the day that article was written, 4/17. This is the Standard & Poor's 500 U.S. stock market today. It doesn't include dividends.
Right.
It's went up 216%. And the reason I bring that up is that in our Back to School Summer Series, lots of things never change.
That's right.
if you base your investment decisions on what the media says, you would have missed all this recovery and reward. And so I personally believe that nothing's going to change. Nothing's different this time on the articles we're reading today. We're going to look back on this time and say, you know what, that's kind of hilarious.
Well, it is always the case. It is always the case that markets overpredict everything, and it is always the case that your highest expected returns are during the worst economic times, and your lowest expected returns are during the best economic times. In other words, when the economy is roaring now, that means from now going forward, you actually have lower expected returns because everybody thinks there's less risk.
That's right.
When the economic times are bad now, your expected returns in the future are higher because everybody thinks there's high risk. This is counterintuitive. This is the opposite of the way we feel. This is the opposite of the way we want to act, but it's the truth.
That's right. And that's why it's very difficult for investors to succeed, because they're wired to feel this way.
Exactly.
Right. Well, thank you, Lauren. Appreciate you watching this episode of Back to Summer School, and we'll see you soon. Take care.
See you next time.
All right, bye.